have suggested that SEC has been moving too fast recently. We've heard all the complaints. I'm sure we'll hear them again today. Too many rules, too fast, too hard to comply with. But America's markets are the greatest in the world because we have strong investor protections and because we have effective regulators at the SEC and elsewhere who work to make sure we have transparent, fair, and honest markets that Americans deserve. We know all too well what happens when regulators, at the behest of lobbyists and the politicians who always do their bidding, ignore changes or are too slow to respond. It was 15 years ago this week that Lehman Brothers collapsed, putting us in the middle of a financial crisis because industry ran wild. Look at the private funds rule the SEC recently finalized. Private equity and hedge funds manage tens of trillions of dollars in assets at the end of last year for pension funds and endowments, now even some retirement savers. Private equity funds alone control somewhere between, this is incredible, and I use that word sparingly because it's overused, but where between 15 and 20% of our whole economy, private equity firms control that. That number is going up every year, but all the Americans whose savings are controlled by these opaque firms haven't been able to get much information about how they're using people's money. Fees, comparable performance data, independent audits, disclosure of conflicts of interest by fund managers. Americans have been in the dark about all of it until now. The private funds rule will change that, thank you, and force them to tell people how much money these private equity firms are charging. It should be no surprise that the groups that complained that the proposed rule was too strong, too hard to comply with, and unnecessary, waited only days before running to their venue of choice, the Fifth Circuit Court of Appeals. Of course, it's always the Fifth Circuit, the most extreme and partisan circuit in America, and always willing to do special interest bidding, especially Wall Street's bidding. Same playbook we see over and over: Wall Street, corporate interests trying to use the courts to go around the public. What else are these companies trying to hide? Trillions in stock buybacks, for one thing. It's why the SEC update of corporate buyback disclosure will also provide much-needed data on how executives are allocating corporate resources. That increased transparency will combine with our first-ever tax and corporate stock buybacks. Together, they should encourage companies to stop throwing trillions of dollars at buybacks that enrich executives. Instead, start investing in their workers and in innovation. The Commission also took important steps to address fraud and increase executive accountability. Under your leadership, Mr. Chair, the SEC finally took steps to complete two safeguards required under Dodd-Frank. The first was proposing a rule prohibiting conflicts of interest in the market for mortgage-backed and asset-backed securities. That sounds technical. During the financial crisis of 2008, Wall Street banks, predatory hedge funds bet against the U.S. housing market, and caused billions of damage. The second Dodd-Frank provision requires companies to work to claw back compensation from executives who earn bonuses based on flawed financial results. This committee's been working to enhance executive accountability by recently passing, and I thank the ranking member for this too, by a vote of 21-2, a bipartisan bill to hold bank executives responsible when they mismanage their banks. I look forward to the Recoup Act passing the Senate and becoming law. The past year, the SEC also advanced transparency by requiring companies to notify the market when they experience cyber attacks. We know this is a growing risk to every industry. Now there's a standard that ensures investors and policymakers know when these potentially devastating hacks occur. Of course, the FEC has continued to pursue enforcement action against all kinds of scam artists, those who target vulnerable investors, people who try to get away with insider trading, and crypto fraudster. You've been busy. There's more work to do to protect American savers. And we know that FEC is looking ahead at emerging risks posed by new technologies, including machine learning and artificial intelligence. The SEC must make sure that brokers and investment advisors put customers first when they use new technologies. This committee will be discussing the impact of AI on financial markets and consumers in the coming weeks. I'm eager to see SEC finalize its climate disclosure rule. There's been significant opposition to the proposal. Who would have expected otherwise? But the transparency it will provide will be valuable to investors. Just last week, this committee heard testimony about the challenges in the property insurance market, the increase in climate events every year, 15 $1 billion or more events so far this year increasing all the time. It's well documented. These climate events affect businesses too. That destruction hits factories and infrastructure, puts workers at risk. So it's clear why investors are demanding this information. They deserve to get it. And we only need to look to events in the crypto markets in the past year to see what happens when markets lack transparency and conflicts go unchecked. Americans lose money. Since you testified last year, Mr. Chair, the FTX collapse showed how dangerous crypto can be. But FTX wasn't a lone bad apple. It was just the most explosive example of the problems in crypto. It seems like every day before and after FTX collapse, there's another crypto scam, hack, or insider taking advantage of people and another few $1 million lost. That's because the problems we saw at FTX are everywhere in crypto. The failure to provide real disclosure, the conflicts of interest, the risky bets with customer money that was supposed to be safe. FTX was just the biggest and the ugliest. For consumers, it adds up to billions of dollars gone. Meanwhile, bad actors keep flocking to crypto. They use it to launder money, to evade sanctions, to fund crime and human trafficking and terrorism. We need to protect workers and families in these markets. We need to clean up the scams and fraud. As Congress considers digital asset legislation, I'm glad SEC is using its tool to crack down on abuse and enforce the law. Lastly, Chair Gensler, as our economy and markets move forward, SEC must keep moving forward, put American savers first. Americans who work hard and scrimp to save for their families' futures deserve to invest their savings in markets that are fair and honest and transparent. I look forward to hearing more about how the SEC is working to protect investors and American workers. Senator Scott.
Thank you, Mr. Chairman. Thank you, Chair Gensler, for being with us today. I've been calling for this hearing since February 14th, when the committee held an oversight hearing on the FTX crypto crash. A lot has happened since your appearance last September. We experienced several bank failures, and in response, this committee called up the relevant financial institutions and regulators to hold them accountable for their actions. But when it comes to the SEC, we've had to wait a whole year to speak with you in person. Even when a company like FTX collapses, we still have to wait. Complete and timely attention to congressional inquiries is critical to ensuring independent agencies remain transparent and accountable to the American people. Yet sadly, your agency has fallen short on this obligation to be transparent and responsive to congressional oversight. I have serious concerns with the way you are leading the SEC. The U.S. economy, and more specifically, our capital market system, is the global gold standard and one of our country's greatest strategic and competitive advantages over our peers and our adversaries. However, the United States can only retain these benefits if our regulatory environment empowers budding entrepreneurs to innovate, launch, and grow new job-creating ventures. America's global competitive edge is innovation and the American spirit to create. As SEC Chair, your goal should be to fuel competition and innovation in the marketplace and expand the ability of Americans from all walks of life, whether that be a Boeing aircraft mechanic in North Charleston or a soybean farmer in Fort Dodge, Iowa, to access a wide spectrum of investment options for their hard-earned dollars. Without pro-growth regulations, we are limiting opportunities for our kids and our kids' kids from being able to take control of their own financial futures. That's why it's especially troubling that under your leadership, the SEC has failed to implement these types of pro-growth rules. Instead, your agency has churned out a seemingly endless assembly line of new and unneeded regulatory hurdles to capital formation and market access. Let me go through just some of those rules. First, the compliance burdens of your proposed climate disclosure rule are expected to quadruple the cost of being a public company. And that's just for one single rule. Your tax on private markets through the private funds rule will hurt small businesses and push small and diverse fund managers out of the market, ultimately limiting jobs and opportunity for many in the local economy. Meanwhile, your complex proposed overhaul of equity market operations will harm market access for retail investors and increase firms' cost of capital, especially for small and medium-sized businesses. You've issued several proposals aimed at reworking the regulatory regime for the open-end fund industry, including mutual funds used by millions of America's retirement savers, while providing tissue paper-thin rationale for why these reforms are needed. Despite it being labeled a rule on artificial intelligence, your power grab to regulate emerging and existing technologies, even Excel spreadsheets, is beyond the SEC's scope and will ultimately stifle innovation. Finally, and I certainly could go on with more, but your proposed revisions to the current rules for safeguarding customer assets are so overreaching, you've placed your fellow regulators at the CFTC, the Fed, and Treasury between a rock and a hard place. These proposals and rulemakings will have a tremendous effect on our capital market system. Yet under your leadership, the SEC has failed to conduct thorough cost-benefit analysis, much less look at the overall impacts of these proposals, and has limited the time the public can have the time to analyze and then comment on these rules and the proposals. This is kind of like using all your draft choices to pick a quarterback and forgetting about the offensive line. Rulemakings must be justified and supported by common sense economic analysis, which brings me full circle. Rulemakings must be done in a thorough, transparent manner, which includes responsiveness to congressional oversight, including from the minority members of this committee. The American people have a right to know what their government is doing, and your agency's blatant refusal to respond to our constitutionally mandated oversight represents a dereliction of your duties to the American people. A few final thoughts before I close. I think opportunity can exist for all investors, and it should. Throughout my time in Congress, I've prioritized enacting policies that open more doors to opportunity for future generations and give Americans in every corner of the United States the chance to better their economic standing and build generational wealth. It is clear under this administration and under your time as SEC chairman that regulation, not innovation, is the preferred medicine for every perceived policy injury. This should not be the case. I look forward to your testimony and then our discussion on these questions.
Thank you, Ranking Member Scott. I'll introduce today's witness. We'll hear from Gary Gensler, the chair of the Securities and Exchange Commission. Chair Gensler, please proceed.
Thank you so much, Chairman Brown, Ranking Member Scott, members of the committee. It's so good to be back in front of you, and thank you for inviting me here today. As customary, I'd like to note that my views are my own as chair of the SEC. I'm not speaking on behalf of my fellow commissioners or SEC staff. For 90 years, the federal securities laws and our work to oversee them have played a crucial role for the public, both in good times and in times of stress. And the core principles of the U.S. securities market, regulation, have contributed to economic success. I find Ranking Member Scott and I probably agree on this, is that it really has contributed to our economic success and our geopolitical standing, the success of our capital markets. At this remarkable agency, we serve investors building for a better future and issuers on the other side of the market, raising for their innovations and their ideas. It's about a $100 trillion capital market in total. And the essence of this is captured in our three-part mission: to protect investors on one side, facilitate capital formation on the other, and then what's in the middle? The markets. Fair, orderly, and efficient markets. And the SEC is also a cop on the beat, watching out for your constituents. The dedicated staff of the agency does extraordinary work with limited resources in the face of significant growth of registrants, more involvement in our markets from individual investors, and, yes, increased complexity. The SEC's head count actually shrank from 2016 through last year. We shrank. With Congress's help, along with this committee, we've actually just gotten back to a touch more than where we were 7 years ago. America is blessed with the largest, most sophisticated, and most innovative capital markets in the world, but we cannot take this for granted. Yes, even a gold medalist must keep training. And that's why we're updating our rules for the technology and business models of the 2020s. My written testimony details those efforts, and I'm sure we'll get into questions on this rule or that rule, climate and crypto and the like. But I'd like to just put it all in context. We're updating our rules to promote efficiency integrity and resiliency in the market. That's our goal. We do so with an eye towards investors and issuers alike to ensure that the markets work for them rather than the investors working for the market intermediaries. We're working to help lower cost, increase access, and promote financial stability. And each of the proposals we've made in the last 2 years further that three-part mission as laid out by Congress. Our Division of Economic Risk Analysis provides robust economic analysis, and it considers the costs and the benefits as well as the effects on efficiency, competition, and capital formation. And we greatly benefit from public input regarding the economics, the policies themselves, and the SEC's legal authority. Now, in the last 2 years, we've actually provided the public ample time to comment, with an average of 70 days to comment from the time we put a proposal and we publish it on our website. Since January of 22, we've actually set in place that there's a minimum of 60 days and sometimes as long as 100 days from when it's posted on the website. When comment periods close, though, we often continue to get additional comments through meetings and otherwise, which staff consider as well, and based on the feedback, the staff and the Commission consider possible adjustments to the proposals. This process tends to take 12 to 24 months. And during that period of time, as we move to possible adoption, we only do so after we consider those comments, and we do so based upon those comments, make adjustments. Of the finalized 22 rulemakings that we've made, nearly all of them have changed based on public feedback. I'm grateful to work alongside the remarkable staff and my fellow commissioners to promote the efficiency, integrity, and resiliency of the markets. And with that, I look forward to taking this committee's questions.
Thank you, Mr. Chair. Because there will be a huge turnout on both sides because of the interest in your work and holding you accountable and asking you questions, I'm going to more than usual enforce the 5-minute rule. Starting the questions with Senator Tester of Montana.
Yeah, thank you, Senator Brown. I appreciate your courtesy. Chairman Gensler, thank you for being here. I appreciate it. You know, as many of the folks know, I'm somebody that's still involved in production agriculture. If I don't cut the crop doesn't get cut. The question is this: I wish we were all in a situation where we didn't need access to capital, but we need access to capital. I wish we were in a situation where I didn't have to sell grain to, multinational corporations that I believe need some regulation on them because I think they control the marketplace far too much. But unfortunately, that's where we're at. Every once in a while in the mail, far too often, in my opinion, I'll get a survey as to how much grain I raise and how much grain I have on hand and how many cattle I have and chickens and pigs and horses. It's a real pain in the butt. And the problem is you get to do this over and over and over again. So surveys aren't something that I'm real crazy about, okay, because I'm busy trying to make a living. We have had previous conversations about making sure that the proposed climate rule does not lead to burdensome reporting requirements, to add additional workload, pain in the neck, and I'm being generous when I say pain in the neck, to agricultural producers who do business with publicly traded company, which, by the way, is by far and away the vast majority of folks in production agriculture. I appreciate you've been receptive to those concerns. We have discussed previously in this hearing that it is not the Commission's intent to have farmers or ranches in Montana or any other state or any other producers have to report on goods that they sell to publicly traded company. I want to make sure that that still stands true. Is that right?
That does stand right, sir. We oversee public companies. That's it. One, we're not a climate regulator. We're a securities regulator. And right now, just to give you an example of the top 1,000 companies by market cap, about 80% of them make climate risk disclosures. But we're just trying to bring some comparability to that. And we've heard from not just you, but from many farmers and ranchers across this great land, from a lot of small and medium-sized enterprises who've said, look, we don't want to fill out the surveys, as you said. And so I've asked staff to really take a close look at those comments to make sure that we're only regulating the public companies and not somehow indirectly those private companies.
You're fully aware that it's going to take more than your intent for this happen. Bleed down of regulation is something that happens all the time. And I just want to make sure that it is crystal clear that people in production agriculture are not going to be faced with these surveys.
No, and I can't prejudge a final rule. It does take 5 of us on the commission to push out a final rule, but staff has heard these comments. There's thousands of them, and I've asked staff to come up with solutions.
Okay, so walk us through, that you answered my next question with that answer, but walk us through for the companies required report scope 3 emissions. What do you envision that reporting would look like?
Well, again, because public companies currently report some greenhouse gas emissions, that's which they produce, so-called scope 1, and as you called it, scope 3, their supply chain. That is not as well developed currently. And in our proposal, we said that no private entity, farmers, ranchers, small businesses, needed to report that, and that the public company, if they're reporting it and they found it material, they could estimate it. But we've heard comments that that wasn't good enough from you and from others, and that's where we're looking about how we can find appropriate path forward. Because again, about 80% of the top 1,000 companies are currently reporting on climate risk. Over 50+% are reporting scope 1 and 2, not scope 3. And so we're looking through that.
Okay, and it is important to note that these are publicly traded companies. A lot of family farms have incorporated, but they're not publicly traded.
That's correct, sir. And our jurisdiction is just over those publicly traded, or in public registrants, I'll call it.
Correct. With respect to the chairman, I hope somebody gets into crypto, but I would love to find out what you're doing to protect consumers there. I yield, Mr. Chairman.
Senator Tester, I think several people will. Senator Crapo of Idaho is recognized.
Thank you, Mr. Chairman, and I appreciate Senator Scott allowing me to take this slot for my questions. I do have a number of questions on climate rule, the open-end fund liquidity rule, the crypto rule, and so forth. But I'm going to focus my questions this morning on what you described as the fact that one of your roles as being the cop on the beat to protect investors. I've heard from many Idahoans how they've been impacted by the troubling trading halt of the metamaterials, or MMTLP, investors across the country share these same concerns. They have a lot of questions about what happened, the inability to sell the stock, and potential IRS implications. And to get answers about what happened, they'd sent letters and made Freedom of Information requests of the SEC and I believe FINRA as well. And as of this point, I don't think we have the full response. And you know that my office has engaged to get answers as well. Can you confirm that the SEC is reviewing the trading halt from December 2022, and will you commit to publicly releasing the SEC's findings on this investigation?
Let me just sort of step back. FINRA is separate from the SEC, and they have a set of rules. They're organized, and those rules are approved by the SEC after public comment, but they then move forward and implement their rules. The matter that you raised around metamaterials, if I recall the name of it, in December of 2022, if I recall. Under FINRA's rules, they sought trading halt. They didn't seek the SEC's advice or permission on that. That is something that they did separately in that matter.
So is the SEC not investigating these actions at all?
The SEC's role is to investigate many things in the capital markets. We don't speak to specific investigations, but we do, on a regular basis, examine FINRA for compliance with their rules and examine them on a regular basis on whether they're following their own rules as put out to public comment.
And are you examining their process and their compliance with their own rules with regard to MMTLP?
We regularly examine, because they're such an important part of the capital markets, we examine them annually, I think. Part of our division of examination has a whole unit that examines FINRA on a regular basis.
Well, I don't know whether this question relates to you or FINRA or both, but the investors have asked for the aggregated audited share count for the MMTLP and for the blue sheet data to ascertain whether MMTLP shares were subject to counterfeit and naked short selling. Have FINRA and the SEC analyzed MMTLP for any potential fraud or wrongdoing?
We seek to analyze fraud and wrongdoing wherever it might be in our capital markets, and certainly we're well aware of these matters, but I can't speak about specific possible investigations or even confirm or deny whether we have them, because it protects the markets. When we sometimes close an investigation and we don't find something. But certainly we could follow up staff about the specific questions about data.
All right. Am I hearing you say, though, I do believe I'm hearing you say that there could be an investigation underway, but you can't give data about it. But if there is an investigation underway into these matters, and if that investigation finds answers, is that information not going to be made available to the public?
We only make information as a result of any investigation public if we either settle or bring charges in competent courts. And that really helps protect the public and protects individuals when we don't bring charges.
Well, then how are investors and, frankly, Congress to know whether you have even undertaken such an investigation or whether such an investigation has resulted in any outcome?
Again, part of, I think, the trust in our capital markets is being a cop on the beat, but also when we close investigations that do not result in either litigation or a settlement, that's really between those various registrants or market participants that it's been closed, and they have a right to say if it's been closed or not.
Thank you, Senator Crapo. You can follow up, obviously, with written questions.
I see that my time has expired. I will be following up with you on this issue, Chairman Gensler.
I look forward to it, Senator, and just let us know when you'd like to.
Thank you, Senator Crapo. This week is the 15th anniversary, Mr. Chair, of the collapse of Lehman Brothers, as we've discussed. The 2008 financial crisis showed us all how everyday people can have their lives turned upside down due to Wall Street greed. Now Wall Street's pushing back on your attempts to make them tell investors the real facts about their businesses. What steps is FEC taking, are you taking, to ensure that investors and savers have the information they need to make informed choices?
Well, investors get the basic bargain. They have to have complete information. And so that's, if they're public companies, to really have that full, fair, and truthful information. And there's that discussion we had with Senator Tester about climate risk, or what you mentioned, Senator, around cyber risk. Material information is part of what they need to make their choices. Also in crypto, that to the extent a crypto token is a security, that investors get a chance to make their decisions based on that full, fair, and truthful disclosure.
You noted in your testimony the SEC recently finalized the private funds rule that will require private equity and hedge funds to increase transparency for their investors. How will providing additional information on fees and performance help protect workers' pension funds, especially also charitable endowments and for other investors?
So this field has grown significantly over the years, measured, as you said, well over $20 trillion of assets. Well, standing on one side are the investors, and those investors often are pension funds, and the workers and the teachers and firefighters in your districts and your states benefit. And so it's really, we proposed and we finalized, based on public comment, rules to bring greater transparency about the fees, the performance, and what's called side letters that these private fund advisors have in this marketplace. And that helps promote competition. I mean, that helps promote, really the efficiency of the market. And if the costs come down, that means the returns for retirees goes up.
Thank you. As promised to Senator Tester, there will be at least one question, a series of questions about digital assets and crypto. Frauds and scams in the crypto markets cost consumer millions. Decades ago, the same kinds of problems were all over Wall Street. Unscrupulous promoters pushed investments in speculative or even bogus companies in some cases. Investors cashed out, putting their interests ahead of their clients' interests. We cleaned up our markets through investor protections like strong disclosures, conflict of interest rules, always a work in progress. Thank you for that. But U.S. markets, as we know, lead the world in transparency and integrity. Question, Chair Gensler, if crypto markets lived up to the investor protection principles we have in other markets, would that help protect Americans from the crypto abuses that cost consumers billions?
If they were to live up to the investor protection built into their current laws, it would help investors. But right now, unfortunately, there's significant noncompliance, and it's a field which is rife with fraud, abuse, and misconduct.
Thank you. Senator Warren and I have introduced our bill to create comprehensive standards in workforce disclosure because we know the investment in worker development and training is critical to so many industries. I'll be entering questions for the record on that important issue, and I think that Senator Warner will be asking about that later. Last question. Majority of the largest companies already disclose information about climate and greenhouse gas emissions on a voluntary basis. They do so because investors demand that information, but without a clear standard, that information is not easily digestible and is not comparable across companies. What is the SEC's role in making, what is your role in making these disclosures, which, as I said, investors are clamoring for, making these disclosures useful and able to be compared and analyzed?
It's a role that Congress gave us over the decades to help investors be able to compare information that companies are putting out, and it's about material information. And investors, as you rightly said, are making decisions today based on the climate risk disclosures, including greenhouse gas disclosures of the major companies in America. That's already happening. And so our role is just to bring some comparability and consistency to this. And that's what we put out a proposal. We got over 16,000 comments. Like other rules, we're likely to make adjustments. Like the discussion I had with Senator Tester, particularly, we got a lot of comments around what's called Scope 3 disclosures, and that's what we're trying to move forward on.
Thank you, Senator Scott.
Thank you, Chair. You and I had a discussion about the importance of being responsive, especially to the minority, and I want to have that conversation with you. But before we get there, I do want to ask a couple questions that I think are relevant. Chairman, in April, Chairman McHenry and I sent you a letter regarding your proposal impacting mutual funds and retirement savings. We expressed our concerns with the inherent unfairness of creating a two-tiered market that would significantly impact retirement savers at a time. Interesting. Even God's upset with this. At a time when so many are struggling with rampant inflation, not to mention that your liquidity risk recharacterization of mutual funds would significantly alter investment strategies for everyday retail investors. It's saying something when a proposal like yours brings a large and diverse group of stakeholders out against it. Given the current SEC's tendency towards rushing to finalize rules, my fear is that you will finalize this proposal without properly addressing my concerns and the concerns of so many in the industry, as well as those of the retirees and the customers. Or worse, finalize this rule or proposal with an entirely new structure like we've seen in the money market fund reforms rule. Are you willing to rescind this proposal so as to not create a two-tiered system and unfair advantage for large swaths of investors?
As we move forward with this, considering this, we got a lot of comments, as you said, about this proposal. It's about open-end funds, mutual funds, as most people would call it, and to ensure for their, at times of stress, that their pricing matches up when somebody redeems from a mutual fund, that the remaining shareholders in that mutual fund aren't bearing what's called dilution. We got a lot of comments, including your letter with Chair McHenry, which we appreciate. And we'll make considered choices based on the economics and, as you said, based upon ensuring that investors' interests come first.
I think it's incredibly important, and I bring that up because as a guy who used to sell mutual funds, I see the challenges that will be presented to customers who are purchasing those mutual funds. And and frankly, the two-tiered system that I'm talking about. But relatedly, despite your reassurances that the public, especially the millions of everyday investors most directly impacted by these proposals, would have sufficient opportunity to provide feedback through the notice and comment process, your agency provided just over 90 days to sift through nearly 1,700 pages of 4 proposed rules wrapped into one proposal. This same proposal included roughly 1,200 questions from your staff for industry feedback. If you have over 1,000 questions, I fail to see how you can say with a straight face that you have issued a proposed rule and not a request for information. Do you think 90 days is a reasonable amount of time for the average investor or small business to digest a complex proposal that includes 4 rulemakings, including by answering roughly 1,200 questions, again, in just 90 days?
I feel very proud of the agency and the work to comply with the Administrative Procedures Act, to seek that public comment in the equity market proposals, as you mentioned. We voted them in December of last year. We kept the public comment file open until March, the end of March, so 100+ days from when we put it on our website. And we continue to get meetings and comments, and the staff takes those into consideration as well.
I'll just say that 1,200 questions for small businesses, investors to answer in a 90-day window seems a bit of a high bar. But the Dodd-Frank Act required about 400 rules from financial regulators, and 67 of those would come from the SEC. Today, it seems like we are living in the twilight zone, asking people to comply to unrealistic timeframes with too many questions, and frankly, as you can tell, too many rules from my perspective. According to the Committee on Capital Markets under your leadership, the SEC has put forward 47 proposals, adopted 22 of them in the first several months of your leadership. What's even more troubling is these rules stand to completely change our capital market structure, which benefits the average investor more today than at any other point in history. The breakneck pace you are pumping out regulations should not be applauded. The regulations the SEC has proposed under your leadership are unjustified and are sowing discord and confusion for industry and market participants alike. How do you square your mission, which includes maintaining fair, orderly, and efficient markets, with the upheaval of market functioning you aim to create? And I only have 10 seconds for your answer because he's getting ready to cut me off.
I thank you. I would note we take our 3-part mission very seriously, but Bloomberg Law recently wrote an article that said we're actually behind 3 predecessors, Chair Clayton, Chair Shapiro, and Chair Pitt, that in those 22 final rules, that we're 4th out of all 3 of my predecessors did more final rules in their first 2 years and 4 months. We take this very seriously. We're not working against a clock. It tends to take 12 to 24 months if we were to finalize a rule. We've reopened 18 of the rules. There will be changes in most of these rules based on public comment and economic feedback.
Thank you. I know that
Thank you.
over time. Thank you for your
Senator Menendez of New Jersey is recognized.
Thank you. The use of artificial intelligence is becoming increasingly prominent in a number of industries, including the financial sector. The tools can provide enormous benefits to investors, but they also come with a variety of potential risks. Can you describe how the financial sector is deploying AI, and what are some of the potential risks you can see as AI tools become more widely used in the capital markets?
Predictive data analytics and artificial intelligence already have been used, and used extensively in finance, even before the recent ChatGPT. It's used in robo-advising and in brokerage apps, but it's also used by large, sophisticated investors who may be listening to this testimony right here and having computers analyze it and making market decisions. That's called sentiment analysis. But they also drive efficiency in the capital markets, good efficiency in the capital markets on account opening documentation and compliance, and insurance companies are using it to also to do claims processing, to comply with anti-money laundering. I think there are some risks, though. There are some risks in our capital markets some which could lead to conflicts in the market, and we put out a proposal to address those conflicts, some that are harder to grapple with. There may well be that the financial crisis in a number of years or in 10 years is because we find everybody in the mortgage market may be relying on one model, and we all go, my gosh, I didn't realize there was one AI model.
I want to point to something you previously commented on, which, and I'll quote it, the challenges of explainability may mask underlying systemic racism and bias in AI predictive models. Minorities already face disproportionate trouble in accessing capital, and poorly built AI tools have the potential to entrench or expand those gaps. So it seems to me that while we can think about what AI can do in the positive sense within the capital markets, the SEC should be focusing on mitigating what are the potentially negative risks. Is that something that you're focused on?
We are. We put out a rule for a comment and proposal around conflicts in the market when a robo-advisor or brokerage app is taking into consideration their interest and maybe putting that ahead of their investors. You also ask an important question about there's often biases in the data themselves. The data being collected often reflects the biases in our great land. And unfortunately, then investment decisions, investment advice might be based on those biases. And outside of our jurisdiction, of course, and other agencies' jurisdiction, credit allocation could be based on those hard-to-explain data and biases. So I share your concern, but at the SEC, we are absolutely focused on some of those issues around investment advisors, robo-advisors, so to speak, and brokers.
2 years ago, the SEC's Asset Management Advisory Committee unanimously submitted 4 recommendations for actions the SEC could take to improve diversity in the asset management industry. You and I have spoken about this several occasions. And the last time you were here, the SEC had adopted 2 of the recommendations. You said the other 2 were still being considered. Can you tell me what progress has been made on adopting the other 2 recommendations, particularly the requirement for enhanced disclosures by investment companies and advisors regarding diversity within their workforces and leadership?
Well, thank you, sir. With regard to that recommendation, one thing we did do, and it was about the time of this committee hearing last year, was that the staff put out an answer to a question we frequently get, is whether somebody can take into consideration an asset manager's workforce diversity and still be in compliance with their fiduciary duty. And we answered that in the affirmative, consistent with the rest of their requirements in their law. And though that didn't, the full recommendation went further, the full recommendation of the Investment Advisors Committee went further, we thought that this was really an appropriate thing to answer that important question.
I hope you'll look at casting votes on some of these recommendations that they unanimously did. Finally, just to follow on the question on the open-ended funds, this is the most significant change to mutual funds in generations. The question for me is, what is the economic analysis that the Commission conducted and how it showed that these changes are necessary? Because when I look at the Consumer Federation of Americans saying the negative impacts this rule could have, retirement savers in particular would be adversely affected by the proposal, it comes to mind as, okay, what was the analysis that brought you to where you are?
The analysis, thank you. The analysis was based upon some real events. In the spring of 2020, as COVID was breaking out and the pandemic was breaking out, many funds in that stressed time were getting redemptions. People were pulling out of the funds, and some of those funds were then calling up the Federal Reserve and the SEC saying, we need support here. Because there were such rapid redemptions and a fear of those rapid redemptions. And so it's trying to address some of those things, and the law says that we should look at things to make sure that a fund's price, when somebody redeems, doesn't dilute the remaining shareholders. So it's looking at that and looking at that very closely. But again, we've heard comments. We tend to make adjustments along the way. based upon those comments. We're taking those comments seriously from you, Senator, from other senators who have raised this, and of course, CFA and others.
Mr. Chairman,
Senator,
my time's up. I just want to say.
Expired.
I don't.
I'm trying to
I just
keep
want to
people
say
to 5
that
minutes today.
we're
Okay.
going to look, I'm going to follow up with questions for the record. That's
Good.
all I
Thank you,
wanted to
Senator. And Senator Rounds.
Thank you, Mr. Chairman. Chairman Gensler, it's been a while since we've had an opportunity to visit with you. I don't send a lot of letters to you, and when I do, I try to make them as precise and clear as possible. We did send a letter on May 10th of this year along with a number of other members, and in it we asked for 3 specific items. We received a response back on one with a chart detailing rules that were being promulgated, but no response to our other 2 requests. Like I say, I don't ask for a lot of different items, but I really do expect that when we do ask a letter that we get an appropriate response back. Ranking Member Scott had basically said that he didn't feel that you were being responsive. And my question to you is there a policy that you have with regard to requests for information from the minority on the committee versus the majority on the committee?
One, I'd like to look and meet with you and see what the questions were. I'm glad to follow up and meet with you in person or over the phone if you wish. But we are responsive to individual members, to their questions, often policy and other questions that we respond to. We do, if there's an oversight request, that comes, as I understand it, from the rules of the Senate and the rules of the House, generally from the committee and the majority. But in terms of the day-to-day questions, we like to engage with you as you wish.
As I say, I don't ask for a lot, but when I do, I really do expect that we'll get a response back pretty clear on our requests. We didn't to the May 10th letter, and I will follow up with you, sir, because I think it's important. In this particular case, we were concerned about the pretty aggressive rule-making attempts that you have right now. In fact, you have 48 new ones, and I think a total of 60 that you were working through. And let me just play with one of them for just a minute. The technology clearly has played a central role to expanding the market access for institutional and retail investors. You have said yourself that we can use technology to make finance more inclusive and more accessible. However, you have not brought that attitude to the Commission, as is evident by the SEC's new predictive data analytics proposal. Although in name the proposal is targeted at emerging technology like AI and machine learning, the proposal creates a restrictive regulatory regime that will govern any analytics tool and is inconsistent with decades of legal and Commission precedent regarding the handling of conflict of interest, including the Commission's own fiduciary interpretation and regulatory best interest from as recently as 2019. I echo the comments of Commissioner Peirce that the new predictive data analytics proposal reveals the Commission's rather hostile attitude towards technology, or at least it appears an ignorance towards it. Mr. Chairman, was this rule intended to encompass essentially all computational tools, not just AI and machine learning?
It's actually technology neutral, and this is an important concept. It's like if an investment advisor, think about a robo-advisor, is telling you their advice, and it's only based on your family and your well-being and so forth, great, thumbs up. But if they're also taking into account their own interests, their profits, their revenues, and the like, therein lies a potential conflict. And whether they're using machine learning or they're using some other data analytics, predictive data analytics, there may be a conflict there, and then this proposal was to get public feedback on how to, in essence, neutralize those conflicts and address those conflicts.
Have you received a lot of responses back?
We are. I think the comment period might close October 10th, so it's a open comment period right now. But I would anticipate we'd get a lot of comment, particularly after the so-called gamification, the focus in early 21 on brokers using prompts to.
I'm hoping that you take a look at that and that we hear more about it before you make a final determination. And also, Mr. Gensler, Chairman Gensler, earlier this year, the Commission proposed the Safeguarding Advisory Client Assets Rule, which, as drafted, would ultimately transform the way in which a bank holds client cash. Requiring cash to be segregated marks a fundamental shift from current banking practices and, for the first time, would broadly require banks to segregate client cash deposits. My concern is that the SEC is inserting itself into matters at the core of the banking system, deposits, credit, payments, and specifically within the jurisdiction of prudential regulators. My question is, does the SEC have the authority to regulate custodial banks?
We put out a proposal that's actually based upon new authority that Congress gave us in 2010 about the assets held, investment advisors and their custodial assets. And so that's why we were updating this. And for decades, we've had prior authorities as well, which is a yes to your question, around qualified custodians. Can be banks, they can be broker-dealers, they could be something called futures commission merchants, they can be at the federal level, they can also be at the state level. But then we have a role to say what is required of those custodial arrangements so that the investment advisor is not, losing, using, or misusing a client's assets.
Mr. Chairman, my time has expired, but I will follow up with some additional questions for the record specifically on this particular issue.
I look forward to it. I'm glad to meet in person as well.
Senator Cortez Masto is recognized from Nevada.
Thank you, Mr. Chairman. Chair Gensler, it's great to see you again. Thank
Good to see you again.
I'm going to follow up on the conversation you were having with Senator Menendez on artificial intelligence. And let me ask you this. Beyond disclosing conflict of interest, which you talked about, the new rule that you're looking at, should trading houses and money managers be required to disclose their use of AI in other areas?
It's a very good question. It's an emerging technology. And while we don't generally say that a broker or an investment advisor needs to disclose whether they're using an Excel spreadsheet or whether they're using machine learning, I think that there's new challenges with artificial intelligence, the lack of explainability, the chance for bias and biases in how it's used, the conflicts as we were talking about. And so it might be something Congress would want to take up, such disclosures, but it tends to be that at the SEC we're technology neutral.
So can I ask you, you touched on this, is there currently the ability to audit an investment AI algorithm for biases to ensure that clients and retail customers are receiving advice in their best interests?
It's a very good question that computer scientists as well as policymakers need to grapple with, but the nature of artificial intelligence is that it is sometimes has so many factors, millions or not even billions of variables that it's looking at, it's very hard to explain. And humans are very intelligent, but these models are hard to explain, and thus there can be biases that are hard to explain. And so it's something that I think is a worthy policy area for further consideration.
And then finally, on the regulatory side, let me say, how do you envision the SEC using AI for market surveillance, for analysis, and in enforcement activities?
So we already do in some market surveillance and enforcement actions to look for patterns in the market. And I know that some of the self-regulatory organizations do as well. It's one of the reasons that why we've asked Congress for greater funding this year in 2024 to help build up our technology budget for the emerging technologies.
And thank you. And last time we talked, I'm going to jump to cryptocurrencies, the enforcement that you are undertaking with respect to crypto. There was a challenge at the time because you were understaffed. Do you feel comfortable now that you have the staff that you need, particularly on the enforcement side when it comes to the fraud that unfortunately we're seeing related to some crypto?
I would widen it out. The agency is only 3% larger than we were 7 years ago. So I would say no, we're not large enough as an agency given that the markets have grown 50 to 70% in terms of activity, complexity, et cetera, during that time. In terms of crypto, more narrowly, I've been around finance for 44 years now, I guess, and I've never seen a field that's so rife with misconduct. It's daunting.
Thank you. And then let me jump to clawbacks of executive compensation. We have seen that when a company fails, thousands of people we know can lose their jobs and investors lose their money. Yet too often, unfortunately, we see the CEO and executives walk away with millions in stock options and salaries. So can you expand on the SEC's recently completed rules on executive compensation, and how is the SEC improving rules that limit insiders' ability to trade and sell stock?
So we've done a number of things. 2 were mandated by Congress. One was called clawbacks. The Congress mandated that if there was erroneously produced financials and an executive got paid based on that, they've got to give that money back to the company when the financials are revised. 2 was something called pay for performance. Again, Congress mandated it, and 12 years later it hadn't been done. We got that done. But a third thing as well was something called, it was about how executives sold their stock to the public and that they get in compensation. And we basically at its core said that you had to wait at least until the next quarter's financial results were published. You had to have at least a 90-day cooling off period. To follow the plan, it's got to be kind of on automatic pilot, and then at least 90 days had to go by before you could sell. And that only went into effect about 6 months ago.
Thank you. Thank you, Mr. Chairman.
Thank you, Senator Cortez Masto. As I mentioned at the outset of the hearing, we are more strictly enforcing than I normally do the 5-minute rule because there are, it looks like 20 members showing up. So Senator Tillis is recognized from his office.
Mr. Chair, can you hear me?
Yes, we can. Senator
You heard
Tillis
all
is
that.
recognized.
My assistant said you didn't hear me. I thought you would have interrupted me, but I'll be brief. I guess in response to the letter, we got a 1.5-page response that, in my judgment, was not responsive to the questions. I want to ask you a few here now. One, does the SEC's analysis on each of the 4 rules contemplate the interlocking nature of the rules?
Senator Tillis, just because you may not have been on audio at the beginning, which rules, just so I can understand?
We're talking about regulation best execution, order completion rule, minimum pricing increments, and disclosure of order execution information.
Thank you. Each of the proposals have a robust economic analysis that speak to each of those individual matters. One, which was disclosure, as you mentioned. One, which is the agency itself adopting a best execution rule. One, updating the market structure rules.
I understand.
And so each of those individually address the economics of each of them.
Individually, but are you saying there's no valid, there's no reason to actually understand the interlocking nature of them? I mean, if you're analyzing down a stovepipe, but are you really doing the kind of analysis to understand how they're going to work in tandem as they get promulgated?
So there's 2 other things that we do. It's a very good question. One is we do ask questions about that, and we receive a lot of comments. But secondly, if we were to finalize any one of those 4 rules, and we do this on other rules as well, we then incorporate that in what's called the economic baseline. Every one of our economic analyses, as one of its tenets, has a baseline. So if we were to finalize one of these rules prior to others, then we incorporate that in the economic analysis.
Okay, I'm going to submit a couple of questions for the record, but I just wanted to say that the response was a bit disappointing. It more or less referred us back to the SEC website. But I want to touch on something that Senator Rounds asked about, and it's the safeguarding advisory client assets rulemaking. Given the impact that it has on core banking activities, at what point in drafting did the SEC actually consult or confer with prudential regulators?
I know that our staff has ongoing discussions. This was a new authority that we got in 2010, and the team that worked on it actually had been working on it for 12 years. So there's been ongoing discussions off and on with bank regulators over those dozen years. But in terms of this specific rulemaking, certainly since it's been out, there's been discussions. But I couldn't tell you how many times over the 11 or 12 years before the staff had been working on it.
Mr. Chair, I am going to submit for the record letters from industry that on a couple of subjects, but on this particular subject, it appears to me that there hasn't really been an extensive vetting and discussion with the prudential regulators, and we'll get back. We'll submit that for the record, but. Chair Gensler, unless I can be convinced that there was significant engagement, why wouldn't we just put this rule on hold until we got a more fulsome response, better basis for execution?
Because, Senator, what we do is we put things out to proposal, we get public feedback, sometimes we re-propose, we've done that a number of times, or reopen. And often we just moderate, we change, we adjust based on the public feedback, and we've done that on nearly every one of the proposals that we've adopted, these 22 adoptions.
Just real quick, number one, I'm curious about the analysis that you've done to determine how the rule would impact market liquidity. I'd like to get that. I'd like to ask that for the record. I don't think you could possibly answer that in 45 seconds. I'm going to honor my time limit. I'm also kind of curious as to whether or not you've completed an analysis. If you have, I'd like to see it on the cost borne by the investor on the requirements for the proposal. Just a quick answer within 30 seconds. Have you done much in the way of work, and can we look forward to a detailed analysis on the liquidity question and the impact on investors?
We do in each of our rules look at the economics, and depending upon the rule, some are very germane to liquidity and some are less germane to that. But we do that, and that detailed analysis is put out to public comment, and as you said, is on our public website.
For the record?
Yes, but again, it might be that which is already on the public record. I want to be candid with you, because that's the analysis that we've done.
Thank you, Mr. Chair.
Until Senator Warner of Virginia is recognized.
Thank you, Mr. Chairman. Good to see you, Mr. Chairman. I was going to greet you a lot, but I got a 5-minute timeline. The chairman specifically gave me that notice on 5 minutes. I got 2 topics. Let me get them right away. First is the whole question around human capital disclosure. We all know, we've talked about this many times, 7 years ago, 70-80% of corporate value was in plant and equipment. We're now at over 90% in terms of intangible assets, intellectual property, and human capital. I think investors want to have that kind of information about what companies are doing in terms of investment in their workforce, their biggest asset. Last year, Chairman Brown and I sent you a couple letters. Just yesterday, we reintroduced the Workforce Investment Disclosure Act. And before my colleagues say, oh my gosh, is this some rearing again of ESG or anything else? Like, no, this is something that Chair Clayton, under President Trump, took the lead on. Given the fact that there is this consensus that companies and investors want to know how they're doing in terms of investing in human beings, recruiting and retaining. Last September, you'd like to see, you testified that this was one of the items that were on your agenda. Where are we, and when can we see more action?
Again, you mentioned Chair Clayton. We wanted to see the data and see what happened off of that rule from 2020 for the first 2 years and build upon that, and really be targeted around turnover and workforce issues. And there is some consensus around that, and just trying to find that and stay, as I would say, targeted to really important issues around the workforce and the cost of the workforce, the turnover of the workforce, the retention, the training, as you mentioned.
Well, we'd like to see action. I know you've got a big agenda on this one. I'd urge you to move expeditiously. And again, I say particularly my Republican colleagues, I don't think we can find a CEO anywhere in America that doesn't say their workforce is their number one asset. And the fact that we have such little reporting on that, I think, is an area where we need improvement. I'm going to move quickly to AI. I concur with Senator Cortez Masto on some of the questions she raised, and Senator Menendez. I'm chair of the Intelligence Committee, and I see upside, but I see huge, huge downside. You are an AI expert from your work at MIT, from your July 17th speech. As we think about how we get our arms around this, I actually think the two enterprises in our society that are most subject to interference from AI in terms of undermining public trust is faith in our elections, and there's a lot of talk about how AI could manipulate as we go into a presidential election. But the other entity that is totally reliant on public trust is public markets. And I'm concerned, we've seen a little bit of activity here where there was the fake fire on the Pentagon and that interfered with the market. I'm candidly surprised that we've not seen a lot more interference in Fortune 200 to 500 companies, not only in terms of deep fakes, but AI tools that might generate false complaints about products or, frankly, false filings in terms of regulatory entities. How, in the minute and 30 seconds you've got left, how are you thinking about making sure that our public markets and the trust in those markets are not undermined by the rise of AI across the board?
You're absolutely right. Fraud is fraud, and if you're using AI and you're doing deep fakes in the market, that's a real risk to the markets. And I think that we have good laws, but these new technologies will challenge those laws. And we look forward, if you're thinking about legislation, to work with you on that. But I do think that deception is deception, and I wouldn't let anybody tell you that there's no human behind the algorithm. There's still some human behind the algorithm that's setting the broad hyper parameters. These are the top level. What's the algorithm training on? I would note that there was a deep fake on little old me that I had resigned that was put out in the middle of the summer. And I guess somebody was trying to influence stock market prices or crypto prices one way or the other. And my comm shop had to quickly say no, and that was the
Well, the fact that you're a highly public figure, but those Fortune 200 to 500 companies, and I hope, I'm surprised there's not been more. I agree deception is deception, but I hope as we think about this that we not only go after the generator of the algorithm, but we also realize that the distribution model, particularly if it's coming out of a large language model, we cannot repeat the mistakes we made in social media with the 230 get out of jail free card.
Thank you. Senator Haggerty of Tennessee is recognized.
Thank you, Mr. Chairman. Welcome, Chair Gensler. In your prepared testimony, you referenced novel authorities that granted to the SEC by Dodd-Frank, as you claim, and I'd like to start my comments by briefly addressing some of those before I get into the questions. In several of the recent proposed rules that have been put forth by the SEC, notably the private fund advisors and the predictive data analytics rules, your claimed authority is based on what I view as a very tortured interpretation of Section 913 of Dodd-Frank. As you know, the Supreme Court has recently said that major regulations require clear congressional authorization. Yet Section 913G, the provision that you rely most heavily upon, provides very limited authority to regulate in this space, not blanket authority for the SEC to ignore all the other binding language of the law and completely rewrite the standard of care for broker-dealers and for investment advisors. If Congress really wanted to grant unlimited authority to the SEC, do you think it would have put such an expansive power in a subsection titled Other Matters and buried it in a provision that discussed standards for providing personalized investment advice to retail investors? That's clearly not the case. Basically, any law can be distorted by reading a single section in isolation. For example, in the predictive data analytics rule, the SEC defines a conflict of interest as any interest of the firm. In addition to adhering to an overly literal reading of the law, you also conveniently ignore its clear limitations, which are obviously intended to confine the SEC's authority to, quote, certain sales practices and conflicts. What appears to be happening is that you're targeting a subset of the industry that's despised by the left. By applying a different standard for emerging tech, the SEC is not acting as a neutral party. Indeed, the SEC seems to be targeting many of the newer entrants that are actually expanding Americans' access to investments. In the case of the private funds rule, the SEC already has ample enforcement authority to recover funds on behalf of investors. So there must be another purpose for this rule. What you appear to be doing here is trying to change the negotiating dynamics between two sophisticated parties in favor of one over the other, a clear abuse of power. One of these problems with such an ideological-driven agenda is that important matters that are critical to the SEC's missions fall through the cracks as you waste resources on matters like this. So let's get to a matter where the SEC really should be focused upon, and that's Chinese government-connected broker-dealers. Recent congressional oversight letters and press reports have highlighted the growing trend of broker-dealers with connections to the Chinese government. These Chinese-linked firms are operating retail businesses in the U.S., including Webull, Moomoo, Prometheum, and Tiger Securities. Some of these companies, like Webull, even have registered representatives located in China. As you know, Chinese law is far different from U.S. law. They don't play by the same set of rules. So my question is, how can the SEC and FINRA actually oversee registered representatives and employees of these firms who are located in China? And why should these firms be allowed to register and do business with retail customers in the United States?
You raise a good question, and regardless of brokers' location, whether in China, whether in Europe, anywhere, they want to be in our markets, they've got to participate and play by our rules, absolutely. And they have to be subject to them and subject to examination and have openness to that. And
well, how do you examine and impose the rules on these guys located in China?
Having gone through a lot of challenging negotiations with the Chinese authorities over a separate matter around auditing and inspecting auditors, I share your concern because it is quite a challenge. But we successfully, with Congress's help on something called the Holding Foreign Companies Accountable Act, we got the leverage. Congress gave us additional leverage, and we were able to be successful there. And we've actually been able to, through the PCAOB, the auditing board, to inspect those auditors.
Well, I would encourage this allocation of resources to really focus on these sort of actors. I'd like to turn to another point. Last month, the U.S. Court of Appeals for the District of Columbia unanimously ruled that the SEC's denial of Grayscale's spot Bitcoin ETF was, quote, arbitrary and capricious. They argued that the product is mathematically indistinguishable from already approved futures products currently trading on U.S. exchanges. So my question is, can you explain what the SEC needs to see in a filing to approve a spot Bitcoin ETF? And what questions do you still need answered from issuers about the market and or market infrastructure in order to allow this to happen? I'd just like to get some clarity.
Be very brief, and we're moving on. Chair Gensler.
Senator, I thank you for the question. We're still reviewing that decision and reviewing. We have multiple filings around Bitcoin exchange-traded products, so it's not just that one you mentioned, but it's multiple others who are reviewing them, and I'm looking forward to staff's recommendations. So it's similar questions.
Thank you, Mr. Chair. Senator Warren of Massachusetts.
Thank you, Mr. Chairman. So the job of the SEC is to protect investors, not the fossil fuel industry. And when you were nominated 2.5 years ago, you said that giant corporations should not be able to hide their climate risks from investors. Without a strong climate risk disclosure rule, that is exactly what companies will continue to do. You have a mandate to protect investors. You have strong public support to do this, and I just want to say it is time for you to get this job done. But instead of spending the rest of my time fencing with you over when you're going to get this rule out on climate and a strong rule on climate, I want to shift gears and talk about private equity. When private equity funds acquire a company, they and the companies they buy don't have to follow many of the rules that apply to publicly traded companies and brokers that are selling registered securities. So last month, the SEC finalized new rules that ban some, but not all, of private equity's most abusive tactics. Even so, after the rule change, private equity funds can still use registration exemptions intended for small businesses to raise trillions of dollars in the private market without filing public disclosures. That is a great deal for private equity, not such a good deal for investors. Again, SEC's job is to protect investors, but more and more people are at risk because they're sucked into markets that have weaker rules. Chair Gensler, do you have a ballpark estimate of how much money investors poured into the private equity markets, private markets, including private equity markets, where they're covered only by the weaker SEC disclosure rules?
The private funds total assets under management are about $26.5 trillion.
But how much was poured in last year? Do you know the number? I want to look at what's happening
I'm
now.
sorry, it's in the low single-digit trillions.
Well, does $4.5 trillion sound right to you?
We could get back, but it's probably in the ballpark.
Right. Okay, it's right. So do you know how much money investors put in the same time period into the public market where they got much better protection?
What you're highlighting is there's as much activity and in some years more activity in the private markets than the public markets.
Do you know what the number was last year?
I suspect you're going to tell me.
I am. It was $1 trillion. In other words, the SEC is carefully regulating a public market that handles only about 1 in 4 new investment dollars, while almost 3 out of 4 dollars are going into a private market that has much weaker rules. And those weaknesses are meaningful, even after the rules change. So, for example, private equity firms selling exempt securities don't have to report audited financial data to the public. Also, they don't have to disclose data showing that a company has lost all of its contracts or is getting sued for billions of dollars. Seems to me like that is an invitation for fraud. The SEC was built so that investors could have confidence in the honesty of markets, and now 3/4 of investments that are coming in are not getting those basic protections. So, Chair Gensler, how do you explain to the American people that the SEC, whose job it is to make sure that markets are honest, is standing by while private equity and the companies they own scoop up investor money without any public verification that the books are honest or that they aren't hiding huge risks? Isn't it your job to fix that?
Well, part of what we did in a finalized rule just a few weeks ago was require quarterly reporting on their fees, performance, and side letters, and then at least annual audits of those documents.
So let me just say here, Chair Gensler, since we are really pressed on time, I'm not disputing that you've done good things. I hope I said that right at the beginning. You have. But these look like 2 giant holes to me. And the question I'm asking is, how do you explain to investors who now represent 3/4 of all the new investment money that you're not even making these guys do an audited financial statement?
Well, actually, the rule that we just finished has an annual audit in it. So it's of these private funds, not of the underlying companies, but of the private funds themselves.
Well, let me just say, we're out of time. I really think that given the risks in this market, I appreciate what you've done. There's more still to do, and I hope we can do it as quickly as possible.
I thank you.
Thanks, Senator Warren. Senator Vance from Ohio is recognized.
Thank you, Mr. Chairman. Thanks to you and the ranking member for having this hearing, and thanks to Chairman Gensler for being here. I want to just ask a few questions about personnel at the SEC, Mr. Gensler. So let's just start out with the very top, with you. In 2016, you were the CFO of Hillary Clinton's failed presidential campaign. Is that correct?
I was proud to be Chief Financial Officer to the Clinton campaign.
Great. Chairman Gensler, is it also correct that your current enforcement director, Gerber Grewal, was most recently the Attorney General of New Jersey? A yes or no answer will suffice.
He served his nation well, and he was Attorney General of New Jersey.
So just to recap, the Attorney General of New Jersey is the guy who refused to enforce immigration laws and cooperate with ICE. He also launched, I believe, 8 separate investigations against Donald Trump during his time as Attorney General. Chairman Gensler, is it also correct that your recently hired General Counsel, Megan Barbero, was previously Deputy General Counsel under Nancy Pelosi and litigated 2 impeachment hearings against Donald Trump?
I believe she was Deputy General Counsel of the House of Representatives.
Great. So, and I'll also note that one of your senior enforcement counsels is married to Peter Strzok. My point here, Mr. Gensler, is that you seem to have a very troubling pattern of hiring at an impartial regulatory agency a lot of people who seem to have a vendetta against the former president, and I fear and I worry that that has implicated itself and affected the policy at the SEC. Chairman Gensler, when did the SEC take its first enforcement action against a SPAC? Do you know the exact time?
Senator, we'd have to get back to you. I don't know what decade that was.
So according to my staff's research, September of 2021 is the first time that you guys at the SEC launched enforcement action against a SPAC. So I want to recap just a few things, and then I want to ask a question. First, you were Clinton's finance director in 2016, Hillary Clinton's finance director. Second, you hired anti-Trump enforcement director Grewal in July of 2021. Third, you brought in Ms. Barbero, who was the litigator on 2 House impeachment trials against Donald Trump. You have another enforcement counsel who is married to Peter Strzok. In November of 2021, Senator Warren urged you to investigate the SPAC merger involving Donald Trump's Truth Social company. And in December of 2021, just a few weeks later, you guys launched an investigation using a novel legal theory against the former president's social media company. That is some coincidence, isn't it, Mr. Gensler?
Senator, it is good to meet you in person, but I think you're not correct.
What was I not correct about there?
We follow the facts and the law wherever they are. And with regard to the SPAC field, the Special Purpose Acquisition Company field, there have been abuses, as you mentioned, one in 2018 that we found, and there are times that we do open investigations.
So the problem that I have, Chairman Gensler, is not with you investigating SPAC mergers. The problem is investigating a SPAC merger using a novel legal theory against your boss, Joe Biden's chief political rival. Also against the social media company, which of course at the time, Twitter and Facebook and every social media company had banned the former president. So you can make a pretty good argument that the SEC was using its enforcement powers to silence the chief political rival of the current president. Now let me just offer another observation here. We are rightfully concerned in this chamber, at least on my side of the aisle, about the weaponization of the Department of Justice. But I'm increasingly worried that we should be more worried about the weaponization of the Securities and Exchange Commission. It looks more and more like not an impartial regulatory body protecting investors and consumers, but a regulatory body that it's using its power to silence and immiserate political rivals of the current president of the United States. I have just one final question on that, Chairman Gensler. Have you ever spoken to anyone at the White House about your investigation of Donald Trump's Truth Social?
Sir, I don't speak.
Yes or no?
I don't know, sir. I'm going to answer the question. I don't speak to the White House about anything in our enforcement group or our investigations.
So I'm mindful of. Thank you for the answer. I'm mindful of the time here, so let me just offer one final observation. I have little hope that I could persuade you that hiring committed partisans and using the regulatory powers of the SEC in a way that looks, and I think is, politically partisan is a true threat to American democracy. But maybe I can appeal to your sense of self-interest. If you guys use the SEC in such a politically motivated way, eventually you're going to be out of power. And I have to say, Chairman Gensler, turnabout is fair play. Thank you, Mr. Chairman.
Can I just, sir, Chair? I'm very proud of the agency, and I'm proud of the Division of Enforcement and of my fellow commissioners in considering these matters. The one matter the Senator mentioned actually was settled earlier this year, and it was not with the former president. It's with the company. And it's all a matter of public record, that settlement.
Thank you, Chair Gensler. Senator Van Hollen of Maryland is recognized.
Thank you, Mr. Chairman, and thank you, Chairman Gensler, and thank you for your response to the last question you just received. And I've known you for a long time, and I've also known you as a person who always follows the rules in public interest. So I'm glad to have you chairing the SEC. And you brought a focus on transparency to adapting to changing market conditions and the needs of the investing public, and I want to thank you for your efforts to strengthen the rules against insider trading. Senator Fisher and I had introduced a bipartisan legislation urging the SEC to move in that direction, and you and the others did by tightening the so-called safe harbor rule to prevent it from being used as a backdoor for insider trading. I also want to commend you on your role, along with the PCAOB, in implementing the legislation that was passed, authored by Senator Kennedy and myself, on holding foreign companies accountable in order to make sure that companies based in China, especially, were not using funny accounting rules to mislead investors about the health of their financial balance sheets. And Senator Kennedy and I are working now on the holding foreign insiders accountable legislation, which is now part of the NDAA. We hope it will pass and look forward to working with you on implementation. Now, when it comes to greater disclosure and transparency, I did want to turn to the issue of private equity. And there have been a number of questions surrounding the need for greater transparency in private equity, given the size of private equity in our market, about $20 trillion today. I want to ask you about an aspect of that that has not come up, which is the role of sovereign wealth funds investing in private equity. Because the Congress has tightened the CFIUS rules, we see less direct foreign investment by China-based sovereign wealth funds directly into companies. But we have seen a big increase over the years of investment from sovereign wealth funds or state-backed investors, such as the State Administration of Foreign Assets, SAFE, and the China Investment Corporation, CIC, into private equity. Now, on the one hand, private equity managers here argue that these are not voting members, that this is passive investment, no direct control over the decisions or operations of these funds. On the other hand, as the size of these investments grows, a number of people have raised concerns. In fact, Mr. Chairman, I'd like to put into the record, with unanimous consent, a Financial Times article dated May 30th, 2023, titled, "Has China Become Too Cozy with Private Equity?" ?
Without objection, so ordered.
Thank you, Mr. Chairman. And in that article, it says that because of the lack of transparency, it's a black box. This is Lily McKelvey, who's a China expert at the Center for Strategic and International Studies in Washington. It's not something the U.S. and others have been able to address, mainly because it's so opaque. That was the quote from that individual. The article goes on to point out that we really have no visibility into these investments, and talks about the fact that, especially after the Russian invasion of Ukraine and sanctions against Russia, this became a more important issue for investors in private equity. Could you just talk briefly about how you think about this right now, both the need for greater disclosure in private equity broadly, and I know there's an ongoing case, but could you talk also about this issue of foreign sovereign wealth funds and their huge investment in private equity, and whether that raises concerns and need for greater transparency?
Under our laws, investment advisors here in the U.S. can advise asset managers, including sovereign wealth funds, all around the globe. And if they're properly registered, the advisor has to be, complying with their laws. And you're right, we do have a recent adopted rule about private fund advisor transparency. You're speaking to something about the investors behind that, which, though we have some role to play at the SEC, is also a very important role for other agencies like the Treasury Department. And as you mentioned, CFIUS is a collection of other agencies, not including the SEC. So I'm sort of be interested to follow up to understand what you're thinking, whether it's something legislatively or otherwise. But we as an agency are neutral about which investors from which countries the investment advisor is advising. Our jurisdiction doesn't really go there as long as they're complying with anti-money laundering laws and the like.
Well, I do look forward to following up.
Thank you, Senator Brown. Senator Lummis of Wyoming is recognized.
Thank you, Mr. Chairman, and welcome, Mr. Gensler. My questions are substantially nerdier than my colleagues, but nevertheless, I think they're really important. I'm going to start with Staff Accounting Bulletin 121, which you know I've been harping on for about a year in relation to the Lummis-Gillibrand Responsible Financial Innovation Act. So, Staff Accounting Bulletin 101 requires that companies, including banks, place crypto assets under custody on their balance sheets. And even Fed Chairman Powell has agreed that this is unprecedented in financial regulation in the U.S. So my first question is, you've said repeatedly that this is to provide greater consumer protection. And like we saw in the Celsius bankruptcy last year, when thousands of customers were made unsecured creditors, isn't it true that placing custody assets on the company's balance sheet could result in consumer assets being seized by creditors in the event of a bankruptcy, and that would hurt consumers?
Senator, thank you for actually going down, as you say,
the
more technical rabbit holes, and I'll be glad to go there. It's actually, you're absolutely right about the Celsius finding, but what was interesting in that bankruptcy finding is a judge said these are not segregated protected assets. By and large, that the investors were just lining up in bankruptcy, and that was regardless of a staff accounting bulletin that the SEC put out, because Celsius was a private company. The staff accounting bulletin was staff advice on how to do accounting in public companies. And the reason the staff came to that conclusion, and which is different than for stocks and or bonds in custody, is because the laws in the U.S. right now tend to be that you can't readily, easily segregate those crypto assets the way Celsius was taking it on, and that judge said, you're just in line. And by the way, that's also happened at Voyager, it's happened at FTX, it's happened at Terra Luna, it's happened at each of these various bankruptcies.
Well, let's then talk about the relationship of Bulletin 121 to banks. So the requirement prevents banks from offering crypto asset custody because it requires the assets to be backed one for one by U.S. dollars. And if that standard were applied to legacy custody banks like BNY Mellon, they would have to have trillions in regulatory capital. So that prevents the most heavily regulated financial institutions in the country from offering custody. So if your ultimate goal is to provide real consumer protection, shouldn't the SEC withdraw Staff Accounting Bulletin 121 to allow banks to provide custody?
So the Staff Accounting Bulletin is just about public companies and how to properly show that to investors in those banks. And it's investors, not the people getting the custody. The bank regulators are free to address how they treat capital, however they wish to treat capital. But this is just about, is the balance sheet have those custodied crypto as a liability, but they also have the crypto as an asset. We don't speak to how it's backed. That's up to the bank regulators.
Okay, thank you. I want to turn to the SEC's pace of rulemaking. let's use, for example, the proposal on the use of predictive data analytics to regulate not just AI, but an overly broad description of covered technology, encompassing all uses of technology in a firm down to adding together numbers in a spreadsheet. Even numbers in a financial firm pass through spreadsheets. So my concern here is this rule is going to follow the pattern of others, such as the money market fund reforms proposal, where unworkability means the end rule looks very different from the proposal. The documentation requirements of this rule are so demanding that the industry will not be able to comply. So will you commit to re-proposing the use of predictive data analytics rule if, or rather when, the Commission arrives at a different approach?
And be brief in your answer, Chair Gensler.
Again, we take public comment serious. If we make adjustments, it's based upon whether it's been properly noticed and it's a logical outgrowth. And so we commit to taking public comment seriously.
Thank you, Senator Lummis. Senator Smith from Minnesota is recognized from her office.
And Ranking Member, and thanks so much, Chair Gensler, for joining our committee today. Chair Gensler, when you were here last fall, I asked you about the materiality of climate risk disclosures, and I think that you very effectively explained why this information is relevant to investors so that they have good information and can make informed decisions about their investments. And so it's been a year, and meanwhile, the rest of the world is moving forward. The EU and the UK and the International Sustainability Standards Board have all recently taken steps to implement robust climate disclosure standards. And of course, this will be reverberating across the globe economically. In fact, it's estimated that 3,000 U.S. companies will be subject to these EU standards. So my question, Chair Gensler, is I understand that you can't comment on ongoing deliberations, but could you comment on how you see U.S. leadership on this issue, why you think this is important, and what level of urgency you feel to complete this rulemaking process?
I thank you. It's really about bringing comparability and consistency to that which is already happening, that many U.S. issuers are already disclosing climate risk information, and investors are making investment decisions. And so we just look at it really within that decades-old tradition that the SEC addresses itself to material disclosures and comparability.
And to this point of sort of urgency of establishing and making clear what that comparable standard is, what people can, what standard and expectations we should have around disclosures, when do you think this might be done?
Again, we try not to do things against a clock. It's really when the staff is ready and the commission is ready. We got about 16,000 public comments. The private funds rule that was being discussed a little earlier took us about 19 months or so from proposal to adoption. But again, I don't want to predict on this one. There's a very heavy comment file, and really important issues have been raised around the discussion I had with Senator Tester earlier about Scope 3, but over a number of other matters as well, and we're looking at staff recommendations on how to deal with those comments.
Okay, thank you. I want to dive in on I was smiling to myself as Senator Lummis was talking about getting nerdy on you, so I'm going to dive in for my last question on something that is maybe equally nerdy, but really important. As you know, the Registration for Indexed Linked Annuities Act, which I led with Senator Tillis, was enacted last year. And what this legislation does pretty simply is require a tailored registration form for these kinds of index linked annuities so that consumers that want to purchase these products have good, clear, concise information. So I want to thank you and your staff for working with us on this legislation and its implementation. And I'm wondering if you can share any updates for us on how that's going and when we might be able to expect a first draft.
It's going well. Congress also set a deadline of, I think, of a total of 18 months to not only get a proposal, but to get a final. But one of the pieces that we're working on is Congress also, in that legislation that you co-authored, we had to do some investor testing. And so there's two pieces. It's the investor testing, and it's also the proposal, bringing that up to my fellow commissioners, trying to vote it out, get public comment, and also with an eye towards adoption in the full 18 months that you had laid out.
Well, good. Well, thank you, Chair Gensler. I appreciate your attention to that. Mr. Chair, I cede back my time.
Thank you, Senator Smith. The chair recognizes Senator Britt.
Thank you, Madam Chairman. Chair Gensler, thank you for being here today. We have heard a lot of various things on both sides of the aisle, but in particularly over here about aggressive rulemaking and that agenda. Over the last 2 years, the SEC has proposed nearly double the number of rules that your two predecessors proposed within the same amount of time. The only time we've seen this pace of activity is when the SEC was implementing Dodd-Frank, those provisions after the financial crisis. So the difference here is that your agenda is not being driven by congressional mandate or widespread market failures like we saw in 2008, and that makes me concerned. In fact, it's quite the contrary. 83% of your proposals are not required by Congress, and we have yet to see a market failure that warrants this many new proposals and regulations. Even your own former Inspector General raised concerns about the pace of the activity within your agency and said staffing issues may affect the quality of these rulemaking. To add to this, I believe you have failed to provide the public with justification for these sweeping regulations and have failed to allow for a robust public comment period due to fully understand the broad implications on the market. It makes me think, what constituency is the SEC actually listening to? I don't believe it is the average mom and pop or a 401k investor in the state of Alabama. It seems to be a small handful of politically aligned investors. It's my belief that we want to encourage people to go public so that more people have an opportunity to invest and share in the fruitfulness of the market. I am concerned that some of the things that are going on are going to actually deter people from doing just that. There are countless examples that we have seen, but I want to ask you about the anticipated proposal that I heard Senator Warner ask you about, the human capital disclosure. So when can we expect to see that proposal issued?
Thank you. It's good to meet you.
It's nice to meet you as well.
I worked a lot with your former senator from your great state, Senator Shelby.
Absolutely.
Again, we don't do things so much against the clock. We wanted to see what those first couple of years of filings look like. Chair Clayton and the SEC had put something in 2020. Mm-hmm. We've looked at those. We looked at the data, and the staff is working through.
So tell me on that, actually. So August 2020 is when that was implemented. It seems that when you look at that, we've had a 3-year time period, but the vast majority of that has been during the COVID time period, and the implications on workforce and these things may not be an adequate representation of what they may be in the future. Do you agree with that?
Well, I think it was a very unusual time for our nation, for sure, but this is about the public filings and seeing how public companies had adjusted their disclosures.
So what is missing, from your perspective, from the 2020 implementation that needs to be adjusted or expanded here?
What staff is looking at is the filings and how those disclosures are informing investors about a very important material asset, the human capital itself. And it's possibly around the total dollars spent on workforce and the turnover.
So we don't know when when we'll see that. Is what you said. I'm clear on that, right?
Yes, that's correct.
Okay, and then, but once you bring it forth, how long do you expect to leave the public comment period open for such an important rule?
Well, We'll make that determination at the time, but all of our...
What is the threshold? Can you help me with that?
So all of them since January of 22 have been out to public comment at least for 60 days from when we voted out of the commission.
Really?
And on average, it's been about 70. And I would say even beyond that, because it takes 12 to 24 months to finalize a rule, we continue to take meetings, we continue to take comments, and staff considers those comments.
I am running out of time, so I'll make it quick. Last question. Can we expect to see a proper, robust cost-benefit analysis when you do release this? Obviously, we've been talking about it or hearing you talk about it for 2 years. I am hopeful that you will truly take into account the downstream effects of whatever you propose. I think that some of the things that we've seen, in my opinion, have been half-baked, and I am hopeful with something with such large implications that we will see a very thorough analysis and how it goes all the way down to a lot of the smaller entities that I'm concerned about.
We do robust economic analysis on each of the rules, so thank you.
Appreciate your time.
Thank you, Senator Brett. I recognize myself. Chairman Gensler, it's good to see you. I have several questions for you today and limited time, so please keep your answers concise and specific. I hope I don't have to, but I will interrupt if needed to keep moving on. A year ago, in October 22, the SEC's Office of IG provided its annual report on the most serious management and performance challenges at your agency. Members of various divisions in your organization raised concerns about resource management due to the increase in the SEC's rulemaking activities. As we've discussed, I appreciate your desire to protect consumers and investors and your goal of ensuring that the U.S. capital markets remain the most sophisticated and best in class. These are broad goals that are good for business and good for our country, but how we accomplish those goals matters. The IG report illustrates an SEC with a marked increase in attrition, difficulty in hiring qualified talent, and over-reliance on detailees with no rulemaking experience. These are fundamental problems that call into question the quality of rulemaking that the agency is capable of producing. Now, ambitious agendas under these constraints can result in poorly written rules that can hurt Arizona's access to economic opportunity. So what have you done since October of 22 to address these management challenges?
Part of it is, with Congress's help, is hiring more people. I'm very proud to say that the partnership of partnership of public service actually looked at us, and we went up in the ratings, that we're the third highest rated agency. But you're right, our attrition has moved up. And our attrition moved up in part because it's a very tight job market, and we're about 6 or 7% attrition. That means the average employee stays about 16 years.
I'd like my staff to be briefed by your staff in terms of the specific progress that you've made. So I'll have my team follow up with you.
I thank you for that.
Your own division managers raise these bandwidth concerns with the IG. And do you assess whether or not a division has adequate bandwidth to conduct a particular rulemaking before directing them to engage in that rulemaking? And if so, how do you make that assessment?
We do it with each of the main divisions: investment management, trading and markets, corporate finance, have a rule team. And we do that with the leads of those rule teams that are career staff. And we also do it with the Division of Economic Risk Analysis about their bandwidth, as you say, in each of those groups.
The IG report also cites shortened timelines during the drafting process and shortened public comment periods as factors that your staff indicate may be resulting in less feedback during this process. We've spoken about this before. I want to ensure that stakeholders and the public have time to weigh in on these actions. As we've discussed, more sophisticated firms have armies of attorneys on retainer, but small businesses and retail investors need more than 30 days or 60 days to understand the impact on their business and provide feedback, particularly since these rulemakings are very complex and there are multiple rulemaking processes happening at the same time. So does your agency value hearing from small businesses and retail investors, and how are you ensuring that they have adequate time and the use of their own resources to provide feedback on your agency's actions?
We do value the input of small businesses, of everyday investors. We reach out in many ways through social media and elsewhere to try to encourage people to comment on our rules. And I would note this for the public: whether large, sophisticated investors or everyday investors, we continue to take meetings and continue to get comments during these what's generally year to 2-year processes, and they are very beneficial to us.
The SEC staff also raised concerns that the increase in rulemaking activities had resulted in a trade-off in other mission-related work because they've had to borrow staff to do their work. Has bandwidth allocated to increase rulemaking traded off with your bandwidth for enforcement?
I think the biggest trade-off is that we shrank from 2016 to 2021, and we're only right now about 3% larger than we were 7 years ago. But our enforcement division of about 1,300 people, which is about a quarter of our overall staff, it's not a trade-off because our policy shops are in different parts of the agency.
So my last question is, your staff raised concerns with the IG that when moving more aggressively with rulemaking, the SEC is opening itself up to increased litigation risk. We've seen some recent legal setbacks for the agency, particularly in respect to cryptocurrency. So how are you assessing the agency's litigation risk with respect to the breadth of your rulemaking strategy?
We take Congress's mandates to us and the authorities we have very seriously, but also how the courts interpret them. And we're dedicated and committed to doing things just within our authorities and how the courts interpret it, but we get a lot of feedback also from the public on that.
My time's expired. I'll follow up in further questions later. Senator Daines, you're recognized.
Thank you, Senator Sinema. Chairman Gensler, I want to start by expressing my ongoing concerns with the truly unprecedented rulemaking agenda that you've pursued since taking over at the SEC. I remember when I ran for Congress the first time back in 2012, we talked about the rising power of the fourth branch of government. This executive branch is now that I believe, if our founding fathers saw what's going on, would say there's way too much power and rulemaking by fiat going on there and really lawmaking. Whether it be your crusade against digital assets or your attempts to use the SEC to further the administration's climate agenda at the expense of taxpayers, there appears to be hardly a sector of the U.S. economy that you view as out of reach of your rulemaking authority. In the nearly 28 months you've been in office, the SEC has proposed or finalized 47 substantive rulemakings. Of these rulemakings, more than 80% were not required by congressional statute. This means that the vast majority of the agency's rulemaking agenda has been voluntarily undertaken. Chairman Gensler, you are not an elected official that's beholden to your constituents. You are an unelected bureaucrat who has taken it upon himself to reshape American financial markets to your liking, to the detriment of innovation, of investors, and small businesses. One such rule that's facing broad opposition from across the ideological spectrum, left and right, is the agency's swing pricing proposals. I've heard many concerns that the SEC's swing pricing is both unworkable and extremely harmful for Montana seniors and individual investors. A hard close would also create significant and unavoidable disparities between investors based on their geographic location as well as their investment type. Even far-left groups like the Consumer Federation of America have expressed opposition to the proposal, noting that, quote, the tangible and significant costs associated with the proposed implementation of swing pricing are very likely to outweigh any perceived benefits, end quote. Given the broad bipartisan agreement that swing pricing will impose significant costs on investors with limited benefits to the broader markets, do you still intend to advance this rule in the face of what I would argue is overwhelming opposition?
If I might, I just want to mention something in the generic. We have about 50 policies on the agenda, 50 projects on the agenda. My immediate predecessor, Chair Clayton, successfully finalized 64 adopting rules. It may be that you and I might have differences on the policies, but it's not out of line with what happens. In terms of your specific question with regard to this rule, you're right. We've gotten significant feedback There's kind of three pieces. There's about the liquidity of the underlying funds. There was this swing pricing, and then a third thing about the sort of back office plumbing, but really relevant, this hard close. And we got some very significant comments, particularly on the swing pricing and hard close. And we're taking a very close look at that to see what's appropriate and whether to make adjustments. And as we go along, I can't pre-commit whether we'll finalize or not.
I want to talk about the SECs. And by the way, that comment I made about the rising power of the fourth branch, that's a bipartisan comment, whether it's Republicans in charge or Democrats in charge. I truly believe the founding father here today, they say there's way too much power.
There are really, probably a lot they wouldn't recognize.
Really too much, law-making authority done through, executive fiat that occurs in a bureaucratic branch of government. Turn to the SEC's proposed rule requiring disclosure of financed emissions. One significant impact of this rule is that it will likely lead to widely inaccurate disclosures that will be of little practical use to investors. It appears to me this is just another step in an agenda to discourage investment and access to finance from legal industries to drive an ideology. I have serious concerns that you even have the legal authority to enact such a rule, and I would urge you to withdraw this rule. My question then is, what would give the SEC authority to circumvent Congress and enact rules by executive fiat?
So we do all that we do, and this climate risk rule included, based upon Congress's authority. This is built on multi-decades authority about disclosure. And in fact, President Roosevelt called it initial bill the Truth in Securities Act. And nothing could be further from the truth. We have no climate agenda whatsoever. We're not a climate regulator, sir. But over 80% of the top 1,000 companies in 2021 have been making climate risk disclosures, and 5% were making greenhouse gas disclosures. So it's trying to build some comparability of that which is already happening. We got a lot of feedback. We're going to have to look at that feedback. We're going to have to think about what to do with so-called Scope 3, as Senator Tester and I talked about. We're going to have to think about a lot of other pieces of this, but it's trying to bring comparability to that which is already happening. We're not a climate regulator, sir.
I'm out of time. Thank you.
Senator Reid.
Thank you very much, Madam Chairman. Mr. Chairman, welcome. Could you give a description of the growth, the size, and the power of the private equity sector over the last 25 years, how they've moved into banking, insurance, real estate, a host of other things? And do you believe that these entities are now competitive to banks and large banks and also potentially systemic risks?
The private funds business, not just private equity, but hedge funds and venture capital, it's about $26 or $27 trillion of assets under management. 25 years ago, there was a report. I helped as a staffer help write it, so I remember this. The President's Working Group report after long-term capital management failed. And at that point in time, the entire field was less than $1 trillion. So it's grown significantly in terms of its comparison to banking. The total commercial banking sector in the U.S. is about $23 trillion. And again, you heard the numbers I just said about this sector. And it can be systemically important. It was systemically important 25 years ago when long-term capital management was on the brink of failure. The field is systemically important today.
Now, are advisors to public funds required to maintain AML, anti-money laundering programs, know their customers, and file suspicious activity reports as banks are required to do? And if not, are you concerned about this, particularly with some discussion that reports of Chinese Communist Party-linked companies and Russian oligarchs using private equity funds to invest?
The Bank Secrecy Act gives key authorities to both the U.S. Treasury, but also we have some authorities, and we've been working alongside of them. The answer is they have certain responsibilities. The investment advisors have certain responsibilities with regard to these funds, but we are in discussions about whether there might be important further steps to take consistent with the Bank Secrecy Act.
Now, since these funds, and the private funds, both hedge funds, private equity, et cetera, are, as you've indicated, the larger ones, systemically important, should they report publicly as our public companies do? I mean, they control as much, and one might say even have more leverage over the economy than some of the publicly reporting companies.
It would be a choice of Congress. Our disclosure regime is for public companies where there's over a certain number of investors, or if you're listed on the New York Stock Exchange. These private funds are private in part because they're not listed on the stock exchanges and they don't have over a certain number of investors. So the disclosure that we have recently adopted a rule is just further disclosure to their investors around their fees, their performance, their side letters. But again, Congress could decide to broaden that out.
And would you think that would be an appropriate response, or?
We're a disclosure-based agency. It's about the investors and the investors getting sufficient information to make informed investment decisions. And that's partly why we finalized the rule that we did recently, is just for those limited partners, those investors, to get further information. I think, Senator, you're asking about whether there's broader public disclosure, right. Which would be, we'd stand ready if that's what Congress desired.
Finally, these reports that communist Chinese elements are using private vehicles and Russian oligarchs, does that concern you, and what are you doing if it does?
As a general matter, I think we all probably share the concern about bad actors, whether they be state actors or non-state actors, that use our capital markets for nefarious means. And we do work with other agencies of the U.S. government from time to time around matters of concern. And as we earlier talked about, really working with our colleagues at the Department of Treasury around anti-money laundering and the Bank Secrecy Act in the investment advisor space.
Thank you very much, Mr. Chairman. Thank you, Madam.
One moment. We're going to close. Thank you, Chair Gensler, for your testimony today. For senators who wish to submit questions for the record, those questions are due 1 week from today on Tuesday, September the 19th. The witness will have 45 days to respond to any questions. Thank you again. With that, the hearing is adjourned.
Thank you, Chair Sinema.